Hello and welcome to the look ahead for next week, which starts Monday, the 25th of March. That's with me, Fiona Sincotta, Senior Market Analyst here at City Index. Just a very quick few things before we start. If you've got any questions, then please always pop them into the question box on the webinar program. And also, I'm just going to ask you to read this risk warning for a few moments before we get going. I'm just going to pop myself on mute to give you a moment to read that. Okay, so thank you very much for joining me. Can't believe it. What a week we've just had. That absolutely flew. But we've got another week to be looking forward to. Not as many central banks as I would say this week. In fact, no major central banks, things that we had pretty much all the central banks minus the ECB giving us their rate decisions this week. So, I mean, next week in comparison is going to feel probably a lot quieter, given the volatility that we've seen this week, the surprises that we've seen this week from the central banks. But I think what often happens in the weeks following weeks like this week, which has just been so busy, and you know, really some quite big surprises or reactions to central bank meetings such as the Bank of Japan, the Federal Reserve, which was slightly less hawkish than expected, the Bank of England, again, less hawkish than expected, the SNB cutting rates. So, you know, we've had some big moves going on in the market. And often, I think the week after, or, you know, busy weeks, we do see sort of a continuation as investors continue to digest really what's been going on in the previous week. And just, you know, as we do usually, we'll start off by looking at the economic calendar. This is on the website. I've filtered it for high impacting and for next week, and this is what comes up. Now, as we can see, nothing really happens till Wednesday, so that does give the markets Monday and Tuesday to really sort of, you know, have a think about what's been going on. What these sort of more dovish stances from most of the central banks, apart from the Bank of Japan, who had a more, well, they still had a more dovish than expected stance, even though they hiked interest rates. So even then on Wednesday, it just kicks off lightly with monthly consumer price index from Australia. So that's expected just to tick slightly higher, up to 3.6% from 3.4%. But what we'll do is we'll just move past that and carry on. We've got retail sales as well on Thursday. They're expected to slow slightly. So, you know, what we're seeing here then is that inflation is expected to just tick that bit higher, but we're still seeing a little bit slowing in the economy as retail sales calm down from that 1.1% growth in January, which is really quite strong. So let's just have a quick look at what this means for the Aussie dollar, US dollar. Now, if we can see, we've had a really interesting moves here, and a lot of this we'll see is based on US dollar strength. But you know, if we do get hotter than expected Australian inflation data on that Wednesday and stronger than expected retail sales, then we could find that the Australian dollar finds support around these levels. Now, if we have a look, it did last week get up to that 66.25 high, and it's got this massive engulfing candle which is coming down here. It's broken below the 200 SMA. It's taken out this support level here, and it's now testing this really interesting level here, which is the rising trend line dating back to November last year, and also the falling trend line dating right back to the beginning of 2023. So if we get a full break below this level, then we'll be looking potentially to test this one down here, which would be the 2024 low, which is down at the 64.45 level. On the upside, if we find some support here, and we can get back over the 65.35 level, that means the 200 SMA is going to very much come into focus there around the 65.50. That's going to be the first real major target for buyers. But as I said, we've got the RSI below 50. We've taken out some pretty key levels. So I think, you know, what happens here is going to be quite determining for what happens next for the Aussie dollar, US dollar. So just moving ahead now back to the calendar. So we've got UK data. After the Bank of England last week, this week, depending when you're listening to it, and also the inflation data that we had from the UK, I think, you know, GDP data for Q4, which was the end of last year, feels very dated. And particularly as this week, we've also had PMI data from the UK. So the GDP data is expected to show that the UK economy, or confirm, because this is one of the final readings, is expected to confirm that the UK economy tipped into a recession at the end of last year. However, since then we've had UK GDP data on a monthly basis, which has shown that actually that recession was probably short-lived. PMI data also supports the view that that recession was probably short-lived. And then what I'm showing you here, though, this is the inflation data that we've seen. Inflation cooled this week down to 3.4%. So we've got this position where actually the outlook seems to be improving a little bit, where recession is short-lived, UK inflation is ticking lower towards that central bank 2% target. Obviously, we had the central bank meeting where the two hawks that had, the two voters that had Bank of England policymakers who had previously in the previous meeting voted for a rate hike had actually voted to keep interest rates neutral. So that's the last remaining barrier, if you like, for the Bank of England before it can start looking towards cutting interest rates. And as a result of this, we've seen the pound US dollar fall quite sharply, and that's also on the back of US dollar strength. And we've seen some strong moves in the FTSE as well. So let's just have a look at the charts to see where we've been going with those. Like I said, so we do have this data next week. I don't think it's going to be particularly market moving, but you know, if we just have a look at this move that we've seen in the pound US dollar over the past 2 days, you know, maybe maybe the pound doesn't need too much more market moving information right now. So, you know, we had the pop up here to the 128 level. Now that happened after the Federal Reserve interest rate decision, which although they left rates on hold, the fact that they maintained their 3 rate cuts guidance for 2024, even though we've seen hotter than expected inflation in the US, actually allowed the US dollar to fall, which lifted sterling US dollar. However, this here, you can see that engulfing bearish candle, that was the Bank of England when we saw the more hawkish than expected vote split. Also, we've got Bank of England Governor Andrew Bailey saying that, you know, potentially a June rate cut might not be so ridiculous. The market's currently pricing in just over a 70% probability of a June rate cut, which is up considerably from around 50-50 at the start of the week. Now, just let's have a look at what's been going on in this chart. So after facing rejection at 128, we've seen the price fall quite sharply. Now it's fallen below this. So this is that falling trend line dating back to July last year. It's taken that out. It's also fallen below the rising trend line dating back to late October last year. Just testing here, we've taken out, or we're testing around this 126 level. We're looking to take that out. In fact, it's just been taken out. And that's a level which has offered support on several occasions at the end of last year and the beginning of this year. And then we're just testing the 200 SMA. So if we get a break below this 200 SMA, or even a weekly close, if we get a close below that 200 SMA, then I think that combined with the RSI below 50 is going to keep sellers optimistic of further downside. We can see we've got this sort of support range coming in here around the 125.25 to the 125 level. If we get a close below the 200 SMA, that's a level that I would be looking at next. If we do find that supposing we have much stronger than expected GDP data next week, which I mean, it's, as I said, unlikely given the fact that it's one of the final readings, but you know, any sort of strength on the pound could see this the 200 SMA hold and also a move back over the 126 level. If we do get above there, then I'm going to be looking for around this region, around the 126.80. That's where we've got sort of, you know, these different trend lines meeting. Also, if we just go back, you know, across the last couple of weeks here, we can see that there have been, you know, some resistance around that level. Breakthrough there will bring 128 back into focus. And with all these strong moves going on in the pound, we can't avoid the FTSE. Let's just have a look at what's been going on here. Phenomenal chart, look. So the FTSE, as we know, it's been sort of, you know, pretty much in the doldrums for quite a long time, steadily just grinding higher. We've got this rising trend line here. It's held above the 200 SMA for quite some time. And then we've just seen sort of quite an encouraging recovery from the 7600 level, and that was sort of running into resistance here around the 7785 and then the 7800 level. But we got a breakout of there, and that's taken us all the way up to 7940. That was a fresh 10-month high today. Just be wary though, we can see there that long upper wick on the candle suggests that buying demand at those higher levels was actually quite weak. So that's why we've seen the price come down a little bit. RSI just teetering on over support there, overbought territory. So, you know, a period of consolidation around this level perhaps wouldn't be surprising, but we'd need to see the pound really continue to hold those losses in order for the FTSE to remain comfortable at this level. And that is because the FTSE is made up of around 80% of multinationals who benefit from a weaker pound. So yeah, just as far as levels to watch, you know, if we do get a rise above that 70, this is 7900, but if that was the May 2023 high, get a break above that and the 7960 level, which was today's high, then, you know, we could be looking back towards 80,045, so 8,045, which is the all-time high. As far as support is concerned, be looking around here, the 7800. That could be a level of support before the 75 level, which is a level which was quite firm at the beginning of the year. So just moving on, what else have we got? German retail sales. As we can see, you know, the economic calendar isn't that packed. German retail sales there, it fell quite sharply last month in January, falling 1.4%. I think I've just got a visual of how German retail sales are doing. Just bear with me whilst I find it. So here we go. German retail sales. We can see here the last few months, they've really been, you know, weak. We've seen a definite, the German consumer has definitely been struggling over the last few months of 2023 and the beginning of 2024. Not surprising given the weakness in the economy over this period as well. We've got, you know, inflation has now started to fall quite considerably. That's obviously going to bring some ease some pressure on German households, but you've also got house prices in Germany have fallen by 8%, which is a huge amount. for Germany, and that's obviously going to be affecting consumer confidence, and also the but what I will say, we've also got the PMI data, which has been weak, particularly the manufacturing sector, which remains very much in contraction. But what's really important to remember here is I think we are starting to potentially see that the downturn is bottoming out. So we're starting to see the service sector and the PMIs is starting to inch higher. We've had IFO business climate data came in today. It was stronger than expected. We're seeing a gradual increase in business sentiment. We've also seen that economic sentiment is starting to improve, albeit slowly. So there are signs that the economy is bottoming out. But let's just have a look to see what this means for the DAX. So the German DAX, all-time highs, fresh all-time high today, in fact, is just easing off slightly as we speak. Well, but look, I mean, you know, this has been a phenomenal rally, and this is basically on the back of expectations that the ECB is going to start cutting interest rates in June, and also the Federal Reserve is expected to start cutting interest rates as well, potentially in June. A lower interest rate environment is more supportive for businesses to grow, and yeah, so you know, we've got the strong rise higher here. As far as sort of technicals to be watching out for, we've got this sort of rising trend line, which it seems to be following higher really quite closely. You know, we do just need to be wary. We've got this overbought situation in the RSI, but I think, oh sorry, I think this you know, if we continue to see some consolidation potentially here, to get that RSI out of overbought, could even see a slip lower. Immediate support there around the 18,044. That was the previous all-time high. But buyers are going to be aiming for that 18,500, and as I said, on the support side, you've got that 18,044. Below that, then you'd be looking at around the 17,600, which is the March low. Also the rising trend line support. This is the rising channel, the lower band of the rising channel there. So and that's at 17,600. Other one just to be looking at is Euro US dollar. Can't really talk about Germany without having a quick look at the euro. Again, this is a really interesting chart. A lot of the sort of US dollar strength is showing through here because we didn't have an interest rate decision from the ECB this week. But obviously, we had the interest rate from the ECB previously. So the euro wasn't getting as much love in the sense that there wasn't particularly much data. We obviously have PMIs, but they haven't. Although they, you know, shown an improvement, the composite PMI for the Eurozone is now up at 49.9, so just verging on the moving into expansionary territory. But yeah, we can see the euro is gonna struggle a little bit because the ECB is expected to be one of the first major central banks, not the first, because obviously we had the Swiss National Bank yesterday cut rates, but the ECB is expected to be among the first, and that's keeping pressure on the euro as well. We've had many ECB officials now really signal that June is going to be a key month for a potential rate cut, although they're not really sure what's going to happen thereafter. That's what they've been sort of suggesting, is there's a rate cut in June, but what comes after is uncertain. Now we can see, again, we've got that rising trend line dating back from mid-Feb. And that sort of offered some resistance as it crossed with the falling trend line from the start of the year or the end of last year. The price has fallen. That was at 109.45ish, wasn't it? 109.40. There we go. Price has fallen down. It's taken out that support there at 109, round number. There's the 200 SMA that's also being tested and taken out right now. Again, a close below that 200 SMA I think will be quite significant. That's at the 108.40 levels. We'll close lower than 108.40 at the end of this week. Will be important. And if we do get a close below there, then that's going to bring in the 108 level, which is the March low. From here, we'll be looking at 107.25 and the 107 2024 low. As far as upside is concerned, if we do find that that sort of 200 SMA is a magnet and gets buyers back over, then they're going to be looking up for that 109 level, and that's going to be the first level that we'll be aiming for before this here, which is the weekly high of 109.35, before we aim back towards 110 psychological level. So moving on, and what else do we have? We've got US GDP again. Feels like it's rather stale, the data, given that it's relating to the end of Q4. That's what, 3 months ago now. So, you know, that's not probably going to be that market moving. We'll talk about the US in a moment. The main US data will be the core PCE. Before that, though, we've got Japanese inflation data, which is expected to tick higher. So we know the Bank of Japan raised interest rates at the start of this week in a move that sort of had been expected, but they did it in a dovish way, saying that there weren't really going to be too many more. This wasn't part of a rate hiking cycle. It was probably a one-off, and that disappointed the yen bulls, and we saw the yen drop really quite sharply, particularly against the US dollar as it approached multi-decade highs. We'll have a look at that chart in 2 seconds, but just here's the inflation, what's going on. Now, we did see inflation cool, but it's actually ticked back up again to 2.8%. We had that confirmed today. Next week, we've got CPI again, which is expected, core CPI is expected to tick higher again. So that would be supportive of a more hawkish stance from the Bank of Japan and could offer the Japanese yen some support. We could see some strengthening in the yen if we get that stronger than expected data, inflation data coming through. Let's take a quick look at the US to Japanese yen here. Okay, so look, we can see there it's just testing those levels, isn't it? This is the key level for US dollar Japanese yen. It's 151.90. It's the high from November 2023. It's a multi-decade high, around 30 years. And look, we're just seeing it after the price has escalated. Look, here we go. This is the data, sorry, the shoot higher after the Bank of Japan disappointed the bulls. It sent US dollar Japanese yen sharply higher, testing year-to-date highs. It's broken above that. And this here, we can see this long lower wick here. This is sort of around after the Federal Reserve interest rate decision. But look, we're firmly in between these brackets here. So on the downside, you're testing out the 150.90. That's the early 2024 high. On the upside, 151.90. Breakout trade. Just be aware, above this level, this is where we're going to get some concerns of Japanese intervention. This is where we've had concerns of Japanese authorities intervening in to support the yen. So, you know, jittery trades around here could be on the cards. If we get a break below here, the 150.90 level, that can spark a deeper sell-off. I'd say till, you know, I'd look at 150 round number as a potential support ahead of the 148.80. A rise above here, as I said, will bring 152 into focus. Right, just quickly before we run out of time, because we can't run out of time when we're talking about the US, given that it is such an influential economy and huge influence on the markets. We've got core PCE, the Federal Reserve's preferred gauge for inflation. Now, the core PCE is expected to rise at 0.3% rather than 0.4%. So that's just down slightly. It's down at 2.8%. So it's heading towards the Federal Reserve's preferred target of 2%. Let's just have a look here so we can get a visual representation of what's going on. So last month it was quite a lot hotter. This is the month on month. We can see that it was quite a lot hotter than expected. In fact, the hottest level that it has been for some time. So that's December 2022. Okay, so we're expecting it to see it moderate back down to around 0.3%. Again, that's still quite hot, but it's cooler than what it had been. So just obviously had the Federal Reserve interest rate decision. As I mentioned, it was slightly less hawkish than expected, as they maintained, as the Fed maintained the signal of 3 interest rate cuts this year. There had been expectations that they were going to downgrade that dot plot to 2, given the 2 straight months of hotter than expected inflation data. Now, what that meant is we saw the US dollar. Let's just bring up the US dollar. We saw the US dollar, this is the Thursday, Wednesday, here we go. We saw the US dollar drop lower after the meeting, drop down to 103 before powering higher. Now, the strength in the dollar, okay, so we had this weaker than expected or more dovish than expected Federal Reserve interest rate decision, which is what pulled the US dollar and Treasury yields lower. But then on Thursday, we had the Swiss National Bank cut interest rates. Now, what's that got to do with the dollar, I hear you say? Well, what that means is that the Swiss franc weakened, leaving the US dollar as the high yielding safe currency, or the least risky safe high yielding currency. So usually it's US dollar, Swiss franc, but if the Swiss franc's falling, then the demand then goes in, or sorry, if the Swiss franc's got a lower interest rate, then the preferred demand there goes to the US dollar, which is why we saw the US dollar rally yesterday after the SNB decision and continue to rise today. So what does this mean with next week? Core PCE. If we see a cooler than expected core PCE, there is a potential that we could see the US dollar come back down towards that 200 SMA. It's at the 103.70 level. Break below that brings the 103 level back into play. 103.13, that was the weekly low, but I think 103, broadly speaking, is the level we should be watching for. Below here, 235, that was the March low. It's hotter than expected inflation. Going to see the market rein in those Fed rate cut bets, and could potentially push the US dollar index back up towards levels of 105, which is the 2024 high. We just have to talk about gold, don't we? Just bear with me whilst I put it up. We have to talk about gold after that record high this week, after the Federal Reserve, after the SNB. Look at that, 2222. We got up there. That was a spike higher as after the Federal Reserve interest rate decision, but obviously as the US dollar rose on the back of the SNB rate cut, then we also saw the US dollar rise. Sorry, as the US dollar rose after the SNB rate cut, we saw the US dollar, the gold fall lower. It's back below the previous all-time high of earlier in the month of 295. That is the key level now. If we get hotter than expected inflation from the US, that could lift the US dollar, lift yields, pulling gold further still. Look out for this level here. This is key, the 240. 21.46, the previous all-time high from December. We can see that that's offered support several times last week and early this week. Get weaker than expected inflation, then we could be looking for a move back above that 21.95 level and potentially bringing that all-time high back into focus. I did just want to do one last one. We'll just have a really quick look at the Dow Jones Industrial Average just whilst we're here. Fresh all-time highs in the Dow Jones. Look, it's heading towards that 40,000 level. That's going to be the key. If we get any more sort of sense that the Federal Reserve are moving towards cutting interest rates sooner and sort of, you know, supporting that that more dovish stance, then that's going to be the level 40,000. Watch out for it. Also on the downside, 39,284. That was the previous all-time high from the end of February, is the other level to watch out from. Look, this is interesting. We've seen the RSI moving back up as well, so that's quite an encouraging sign after this breakout from this sort of holding pattern that we've been in. So yeah, watch out for 40,000 in the Dow next week. That is all from me. If you've I hope you've enjoyed what you've seen here, and if you have, then please, I look forward to seeing you again next week.